So welcome to the Multifamily Investing Community Meetup. I am Andy Bentz. I'm your host tonight. I'm the principal at Blue Horizon Investments. We help busy people invest passively in real estate through syndication. Before I introduce Travis, just have a couple of housekeeping things. So Travis is going to he's going to walk through his presentation on how to achieve financial independence through passive cash flow investing. Please save your questions for the end. There's no dumb questions. Participate. Travis has got a good presentation tonight. And then you'll get a survey at the end of after the meetup. Give your honest feedback. That helps me, helps the group. So let me introduce, honestly, I put this in one of my advertisements about this meetup, and I have been listening to Travis and the Actively Passive show for a long time. It's one of the first ones I was introduced to in the multifamily investing space, and I was like, man, Travis Watts and Theo Hicks are the two hosts of that show, and it's phenomenal. So if you ever get a chance, you got to listen to it. It really is good, and there's a ton of deep information there. So definitely worth the time. So Travis is a full-time passive investor. He has been investing in real estate since 2009 in multifamily, single family, and vacation rentals. You've heard his voice as the host of Best Ever Real Estate Investing Podcast, The Actively Passive Show. Travis is also the director of investor relations at Ashcroft Capital. He dedicates his time to educating others who are looking to be more hands-off in real estate. So welcome, Travis.
Thanks so much, Andy. Thanks everybody for making the time to be here too.
Yeah, really appreciate it. So how did you get started in real estate?
Yeah, it's a great question. So I'm going to cover some of that in the story throughout my presentation, but basically it all started with, like a lot of folks, with those Robert Kiyosaki books. So the seed was planted pretty early, back in about high school timeframe. I wasn't in a position then to invest, but there was a few takeaways that made a ton of sense to me. And I just made it a point in the back of my mind, when the time comes, I'm going to be in real estate.
That's fantastic. That's really good. And then did you decide then in multifamily? Like, how did your journey go from there?
It was very interesting. Certainly not. Had you asked me, I guess, back in high school, beginning of college, 2009, when I got started, about multifamily, who's buying these apartment buildings, I would have said, well, I don't know, billionaires, hedge funds on Wall Street. I really don't know. So I didn't realize that this was an asset class that regular folks per se can be investing in. So that was kind of one of those light bulb moments that we'll talk about, and a point that after 6 years of single family and doing it all on my own and trying to figure it out the hard way, it finally clicked, and I was finally introduced to some folks actually through a real estate meetup group, a lot like this. It was an in-person event, and these were a couple gentlemen who were doing passive syndication deals as limited partners. And man, I'll tell you, there's nothing more I wanted at that time in my life than to be hands-off with investing in real estate. And so that was a game changer.
That's great. And now you talk about being a full-time passive investor now. Have you ever done syndication yourself?
Good question. So my journey is comprised of 6 years of single family flips, vacation rentals, house hacking, just various strategies. I did a lot. I didn't do wholesaling, but I did a lot of the single family stuff. And then I took the leap straight into being a passive investor in multifamily. So a lot of people do ask me, have I or will I be a general partner, raising capital, doing my own deals? I don't have the intention of ever doing that. And it's just because, like I said, those two gentlemen I was introduced to years ago are full-time LPs today. They've been full-time LPs for 20, 30 plus years. And it's a lot about the lifestyle that you can build with that. And it's a lot about just being the hands-off components. And so we'll dive a little deeper into why that is, and kind of why I feel that way.
Cool. And then, so tell us, what's been your best deal? So you've been investing as a limited passive investor. Whether it was on your on those deals, maybe because this is multifamily, it'd probably be just tell me about what's your best passive investment.
Yeah, sure. So I'm going to first generalize and make a statement here that often if you're going to do your own real estate deals and you're going to be an active participant in the business, you're probably going to have a higher return on investment. That's not always the case, but often because you put your time, energy, and effort, I hope everybody doing that is getting a higher return on investment, or else
Hmm.
why are you doing it? And so to answer your question, I was an LP in a deal out in Arizona. This was about 2016. It was supposed to be a 5-year deal. They ended up selling 18 months later, and all the LPs came out with about a 36 to 38% annualized IRR return. Let's put it that way. So that was a quick in and out and a nice little equity pop. Not having to do anything like I was used to just a couple years prior to that, where I'm flipping homes, and some of those were decent. Other ones were kind of more of a flop. I didn't lose money, but it certainly wasn't a good use of my time and effort. I'll put it that way.
Interesting. No, that's great. And when you invest, do you have a particular market in mind? Are you all over the country, or how do you typically invest?
From a macro level, I'm looking in terms of markets, where people are migrating to, what states are they leaving, where are they going, and then for what reasons. And then, of course, tax friendly, landlord friendly tenant laws, stuff like that. And then, more importantly, well, I shouldn't say more importantly, equally important maybe, where employers are going, where they're
Hmm.
relocating jobs, because as we know, real estate's all about jobs. It's all about your tenant's ability to pay the rent. So that's kind of what I'm looking at. So I've done a ton in Texas, a lot in Florida. I'm in the Carolinas, I'm in Georgia. I've done some Colorado Springs, some Ohio, some Michigan. I mean, I'm really all over the place, to be frank, but there's a few markets I don't invest. I don't do like New York, for example, California. Just it all comes down to my criteria. I'm not telling anybody
Hmm.
else don't invest in those markets. I'm not saying they don't make sense. I'm not saying there's not a particular business model or a syndication group that may be just crushing it there. But for what I'm looking for, which is living on cash flow and some of the things that I mentioned there as far as market metrics, you got a lot of people fleeing, high tax states right now, going
Hmm.
to a more affordable quality of life living. So from a high level, that's kind of how I look at it.
No, that's great. No, that's good. It's interesting. And so have you stayed with one syndicator, or do you have investments in multiple syndicators?
I've invested with 14, maybe a little more at this point, but at least 14 groups, operators, firms, general partners, whatever term you want to use for it. That was a bit of, oh, I don't know, I guess not knowing what you don't know, right? So I was kind of hyper diversifying, so to speak, and just placing my capital everywhere to be conservative because I
Yeah.
just, like I said, I didn't know what I didn't know. So at this point, there's been operators that have subscribed to an under promise and over deliver kind of philosophy. These are the groups I'm starting to double down with, and I'm starting to do less of kind of the student deals and things like that. I still do those occasionally. It kind of depends on the relationship that's in place, but in general, I'm probably going to reel that back to about maybe 5, 6 groups that I work with.
Okay, cool. No, that's interesting. And so you're also the director of investor relations at Ashcroft Capital. Tell us a little bit about that. Tell us, what does that entail?
Yeah, some people get confused when they hear a title like full-time passive investor. They're like, wait, but aren't you doing that actively? Yes, because what I'm talking about when I say full-time passive investor is every single one of my investments that I have, 100% of them are a hands-off investment, meaning I'm not tied to the business plan. I'm not having to drive for properties. I'm not having to do underwriting. I'm not involved in making decisions. I'm partnering up with groups, like your group, like Ashcroft Capital, like these other 14 firms who are experts in what they do. They've got their niche, they've got their formula, their business model. I'm just saying, hey, let me share in the profits with you. I'll put 50K or 100K into your deal. That's really what I'm doing.
Gotcha. No, great. Perfect. All right. Well, I will turn it over to you to kick us off with your presentation.
Cool. I'll dive into that. And so I got a little distracted there at the end of your question, just to complete that thought that I had there. So I've been an investor with Joe Fairless, Ashcroft Capital, for many years. And what happened was Joe had his firstborn, Quinn, his daughter, a few years back, and he had less of a desire to get out on the road and do podcasts and webinars and speaking events. So that's kind of what I'm doing with the company, just a company that I know and trust and have worked with. So it's an outlet to reach people like we're doing here tonight. This is not a pitch at all for Ashcroft. In fact, we're not even going to talk about them at all. This is about building financial independence for everybody listening. And in fact, this doesn't even have to exactly pertain to multifamily. I'm just going to paint the picture for everybody of how passive income or how interest or dividends can get you kind of to where you're wanting to go. So with that, let me share my screen real quick. All right, is that full screen?
Sure is.
Awesome. All right. Well, thanks again, everybody. I'm Travis Watts. We kind of just went through the intro, so I'll kind of blow past that here in a second. But again, just to reiterate, how to achieve financial independence through passive cash flow investing. So a couple disclaimers, I'm not giving anybody financial advice or legal advice. I'm not a CPA, I'm not an attorney, not a financial advisor. So please always seek licensed advice when it comes to making your own decisions. This is for informational and educational purposes. Quick background, we already covered it. Full-time passive investor. I did active single family from 2009 to 2015, flips, vacation rentals, house hacking, having roommates. We're going to dive into that a little bit. And then passive investor for about the last 6 years, give or take, meaning that, again, I'm not actively involved in the business plan. I'm not a general partner. I'm not raising capital from anybody. I'm investing in other people's deals. 12 years, give or take, real estate as an investor. My passion is to help educate others who are looking to do either what I do to an extent or just diversify their portfolios or learn how they can invest with their, self-directed IRAs, stuff like that. I'm just here to be a voice for the passive side. And it's because I couldn't find that voice back when, and there's far more podcasts and webinars and seminars nowadays and conferences. But when I was getting started, man, I'll tell you, some of it was my fault for just not opening my mind to it and going out and seeking this stuff out. But I'm telling you, it's exploded in the industry. And so you guys have a lot of great resources today that I didn't have, but not a lot of people are out here talking about the passive side of the coin. So that's our conversation tonight. Quickly over the agenda, beliefs that paved the way to financial independence. These are beliefs that I had to adopt to get there. Financial independence explained. I want to go in a little more detail about that, not be so theoretical and high level. And then how to generate $100,000 per year in passive income. Not a get rich quick scheme. I'll just tell you that up front. How to match investment criteria, meaning when you choose what types of investments you're going to do, how to match those up to what your goals are, starting with your goal first of mind. And then how to identify your risk tolerance. So we're going to talk about value add multifamily business models, core and core plus. And then 4 steps to achieve financial independence. Again, I'm not giving anybody that advice. I'm going to share with you what formula I used years ago and still today for the most part. I'll highlight the differences to help you get to wherever it is you want to be. So Q&A at the end, got a couple free giveaways. I just upfront and full transparency, I have nothing to sell you guys. I have no books, no, conference things. I got nothing. So I'm here to be a resource for free. If you want to reach out on a one-on-one call, we'll do it. If you want to ask on the Q&A here, great. You want to connect on social, whatever, it's all good. So starting out with a few visuals. I know there's a lot of text and a lot of words there. So what the heck is this? So I'm going to start out by talking about a garage sale, because this is really how it all got started. As I mentioned, Andy, when you asked me the question about how I, first got started. So my dad was out at a garage sale. My parents had split when I was 5 years old. And so I was visiting my dad one summer. I had a few weeks there. It was kind of, didn't have a lot going on, I guess. And so he went out to a garage sale on his own. He bought this book called Rich Dad's Prophecy, which I'll talk about here in a minute. And that was the first financial book I ever read. It was not Rich Dad, Poor Dad. It was called Rich Dad's Prophecy, but it did open my mind to thinking a little bit differently, planting some seeds. And then later I took a lot of action on that. That's basically, where we lived for a number of years, mobile home park, about an hour outside of Denver. And these were kind of the beliefs that I had in childhood from my parents. They were both very frugal minded. I wouldn't call them cheap by any means. I call them frugal minded. There's a big difference there. But I adopted these three beliefs that save, save, save. That's what's going to get you ahead. Save, 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 save your money. They were not investors. And number two was buy the off brand. In other words, name brands are a ripoff. This is just what I was kind of told and raised with. And number three is do it yourself. Why not? You save a ton of money, right? So I want to kind of, show you what that turned into as I left home. So I did this for so many years, you guys, not even kidding. $2 a meal, 3 meals a day was my budget. This is from age 17 when I left home and I went out to go do my college thing, all the way like 2 years post-college. I really stuck to that. So, save, 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 right? And that's a burnt grilled cheese. I can't tell you how many of those I had, more than I want to admit. And then buy the off-brand. I drove a Plymouth Laser, if anyone's familiar with a Plymouth Laser, $800 car. There's the headlights stuck up. It was, man, I tell you, I didn't even have air conditioning. I was out in Florida. So just imagine, summers in Florida with that humidity, no AC. But you know what? Saved some money, didn't I? And then do it yourself. So there's me on a floor buffer. My mom would she'd buy homes, or mobile homes or whatever we were in. And then we'd go around kind of fixing them up and doing everything ourselves. She did most of the work, quite frankly, as you can see, that was my contribution. And so, free floor buffing, right? Saved us $100 probably. So this is a quote I love. I took the road less traveled by, and that has made all the difference. I realized at a certain point, as I was living on, about $8,000 per year, I've got to make a change. This isn't sustainable for a lifetime. I've got to do something different. So again, Rich Dad Prophecy, that's my dad and I there on the left. So that's the one book that planted the seed in about 2007, where I'm going, okay, I'm thinking a little differently. I'm now being introduced to this concept of investing, not just saving. Then I went on to of course, read Rich Dad, Poor Dad. He's a great marketer. Every book you read, it's kind of like, oh, you got to read this other one too. And then CashFlow, Quadrant, great book. If you guys haven't read these, by the way, I mean, they're great foundation books. They're more philosophy, they're more theory, they're more high level, but man, they are effective if you really embrace this stuff. And then Unfair Advantage was another great one. Obviously, I've read the whole series, but these are a few that I read initially. So these planted the seeds for 3 new beliefs that I adopted from these books. Invest for passive income, something I had never heard of in my life. Buy real estate. That made sense, but the only way I knew how to go about doing that is buying single family, which we'll get into. And then leverage other people's expertise. That was one that literally took me 6 years to fully understand. I know these seem simple and maybe straightforward, maybe to you guys, but to me, I struggled with that last one, and we'll talk about that. So 2009 rolls around. This is, I only went to college for a couple of years and I just couldn't take it. It just wasn't my thing. It wasn't the academics. I just didn't want to do it. So the recession happened, as we all know, Great Recession. This is a townhome I bought. This is in Fort Collins, Colorado, 2009, September. And it was a 2-bed, 1-bath. And my mortgage was $640 per month. So this was my first step. I had saved, just like my parents always told me. And I put a down payment down to buy this thing, knowing I was going to house hack it or get a roommate. The house hacking wasn't a term back then. So I had passive income of $600. And it's because of that guy right there. Meet Michael. So Michael was my roommate. And that's us on a 14er, which is a 14,000 foot peak out in Colorado. It's a fun hike. But anyway, he was paying me $600 per month. He was going to Colorado State University for a furnished room. Mind you, a room that cheap, save. I furnished for probably $200 or $300 through garage sales and Craigslist. So pretty good ROI. And then, according to Robert Kiyosaki, the next 5 years, really, I spent accumulating single family. Okay. As I increased my passive income, as I increased net worth, these are just a few of the homes out in Colorado that I was purchasing. But you know what? 2015 rolled around, and this was a game changer year for me because I burned out. I completely burned out because I was taking so much time, so much energy. I didn't even put it in the slides here, by the way, but I was working in the oil industry 100 hours per week, 14-hour days, 7 days a week. So actually 98 hours per week. And I was away from home. I was working in Wyoming and New Mexico. I was working in Saudi Arabia. It was crazy, man. So I just didn't have the time, and what's relevant there is not that I worked in the oil field, because I'm sure probably everybody on this call doesn't work in the oil field, maybe a couple, but I was a busy professional, let's put it that way. And I didn't have the time to dedicate to managing and operating single family homes. That was the bottom line. So not a real photo that I was in, but basically it felt like this every day. You know, I'm trying to paint these homes. I'm trying to rehab. I'm not a handyman, by the way. I had no connections. You know, it didn't come from a family of real estate. So I was running into this crap all the time, and I just got so fed up with it. I was just so burned out. And so I forgot, as I mentioned, number 3, leverage other people's expertise. I was not really outsourcing much, maybe a few contractor gigs where they had to knock down some walls. Everything else I was trying to do on my own. So 2016, I started investing in multifamily syndications. I highlight these gentlemen here on the right. That's Joe Fairless on the far right. That's Frank Rossler. These are the GPs of Ashcroft Capital. Just to use the example that these guys are great at what they do. They go out and they find multifamily deals, they underwrite them, they raise capital for them. And then I learned that I could be an LP, as you see right there, a limited partner in this type of partnership structure, just like the guys I'd met through the real estate group that I mentioned that who were full-time LPs for decades at this point. So I started to really leverage other people's expertise. You can't beat them, I guess join them, right? if you subscribe to that. So these are the types of properties now that I was investing in. I sold off my single family homes through 2015, 16, and 17. I liquidated, I went to cash. Maybe not, the I don't know, wisest is the word, but I'm sure I could have done 1031s and got a little more sophisticated, but I didn't know this stuff. So I just sold, I went liquid, I paid all the taxes, I paid all the realtor commissions, and I just one by one was investing in these properties like what you see there on the right. And this is where I had more passive income rolling in than I had lifestyle expenses. And so that's what I call financial independence. You might call it something different, financial freedom, retirement, whatever. So that was a really big deal. Sorry, my clicker went out. But one thing is it's not about money is kind of what I learned. It's about having choices. When I was so busy and doing single family, I didn't have choices, right? If I wanted to go, hey, I want to go to Europe, I want to go take a vacation, I want to go visit family for a week. I didn't have that choice. I had to work, and grind. And so, on that note of financial independence, all these folks you see here on the left, some people just want to volunteer more of their time. They want to be more charitable, maybe whatever, put more time into their church or their community. The guy in the upper right there symbolizing just a little rest and rapport, a little time for yourself. I certainly didn't have that. I didn't feel like I could be myself during that period of my life. Maybe you want to travel more, they're like on the bottom left. I shared that picture of me on the top of the mountains. That's, amazing life-changing experiences, in my journey. And then maybe it's just more time with kids, more time with family. Everybody has their own why, but here's the deal. Financial independence is the ability to do what you want, when you want, as much as you want with your time. And that's what we're talking about here today. That's the big picture. This isn't about getting rich. This isn't about look how much money I have. This is about having options in your lifestyle. As I mentioned about the GP LP thing, I just wanted flexibility of lifestyle is what I was after more than anything. So again, I mentioned, the definition being when your passive income exceeds your lifestyle expenses, you're financially independent. I say independent because, for me, this happened pretty early in life and I wasn't ready to, go to a 55 plus community or something like that. I mean, I probably wouldn't qualify for it anyhow, but I wanted to keep pursuing passions. I wanted to keep doing things that interest me. I wanted to help people. I wanted to share what I knew and what I was experiencing. So that's what it was all about. So let's take an example goal. I told you guys I'd talk about, 100,000 a year in passive income. So just to use one simple example, if you're getting an 8% annualized return on any investment, insert any investment here that you want to think of, single family, multifamily, Airbnb, it doesn't matter. 1.25 million invested, 8% a year in cash flow, let's say, is 100,000 per year. And you say, okay, either that's high or low based on your perspective. Either you think that's low, you can do a lot better, or you think, wow, that's high, I'm getting 0.1% in the bank. Well, here's a little chart I made. So insert your own, ROI. If you want to go invest in, annuities and bonds and whatever, and get 2% a year, well, put $5 million in then, and there's your 100K. If you want to bump it up to 10%, put $1 million in. But yes, it does take some capital to get to the point perhaps of being a full-time passive investor. And if capital's not, if you don't have that capital or you don't see that happening in the near term, then there's so many other options like what I was doing, flipping houses and being a general partner in these syndications. There's a lot of ways to make money. And we're going to get into that in my 4 steps of what I use to actually achieve financial independence. But hopefully that's a useful visual for you guys just to kind of look through and think about in terms of how you get there. Now, one little disclaimer here is that first of all, I use the word passive income. So that's not, the correct term. I mean, this could be interest, this could be dividends, this could be royalties, this could be whatever you want it to be based on your investment. And then 2, in terms of real estate, this doesn't account for maybe equity upside, right? We're just talking about cash flow off of property. So I'm not saying you buy low and you sell high and maybe you come out with a IRR return like many of you have probably seen on a deal that's 15, 20% or something like that. This is just cash flow that we're talking about. So there's no right or wrong is the bottom line. What matters is your goal. You've got to start with your goals. So let's take 2 examples. I just want to paint this picture really quick. So you got Sally and you got John. 2 completely different circumstances. I run into this all the time within investor relations and working with clients. So Sally says, hey, I want $10,000 a month in cash flow so I can switch to part-time work. Maybe Sally works in IT, she's overworked, and she says, I love what I do. I love my career. It's what I went to school for. It's my passion, except, God, I hate these 80-hour work weeks. They're killing me. John, I want to build up a net worth of $3 million by age 50 so I can retire. Boom. Has nothing to do with cash flow. So how to identify your investment criteria? So this is just a simple slide I created where you've got it talking about, real estate private placements and syndications. There's your sectors on the left. So we could be talking about multifamily syndications, self-storage, mobile home parks, office, retail, hospitality, hotel, et cetera. In the middle, I put risk, meaning there's different business models for all these different sectors. You could be doing new development, multifamily, or opportunistic self-storage, or value add, hospitality, or core and core plus, which I'll cover in a minute. Those take a little more time. And then on the far right's just your own general criteria or just some criteria that exist. Do you want monthly or quarterly distributions, or do you not even care about cash flow because you're like John in that example who says, hey man, I just want a nest egg of 3 million. I care less. I got a high paying job right now. Cash flow or equity, maybe a combination of both. A REIT or syndication. A REIT stands for Real Estate Investment Trust. They can be private or public, but in this case, I'm talking about a publicly traded REIT that you could buy in an IRA or brokerage account or something like that versus a private syndication, which is what I do mostly. What class? A class is like luxury, high-end, new development kind of stuff. B class, a little bit older, maybe 1980s, 1990s, early 2000s. C, you're taking one dip lower, maybe less amenities, maybe no pool or no gym, or maybe further on the outskirts of town. D is kind of getting into some rough neighborhoods, right? Higher risk, higher reward. I mean, everyone's different. I do mostly B and C investing myself. I've done a little bit of A as well. Urban and suburbs, you got to decide, are you one of those folks that wants to do the Miami, San Francisco, Manhattan kind of stuff? Or, you're looking at some, Irving, Texas or Lubbock, Texas or something like that. And then Sun Belt or northern regions, these are just things to think through. Is, that was your question, Andy, at the beginning is, what markets do you invest in? Well, I've taken a lot of time to do a lot of research to decide for myself, which is all that matters. I'm not telling anyone else what to do, of what markets I like and why. So here's Sally's criteria as an example purpose highlighted in yellow. Maybe for her, remember her goal is $10,000 a month cash flow. She likes multifamily, self-storage, value add, and core plus kind of risk tolerance business models, monthly distributions, private syndications, B and C class, suburb markets in the Sun Belt regions, just as an example of what she might be looking for herself. John might be like, here's highlighted in green, multifamily and hospitality. Maybe John works in the hospitality industry and he knows it well. I don't know. He likes new development and opportunistic. And opportunistic's like something that perhaps is highly distressed. It's got low occupancy. It's got some issues on the property. So you're going to work with an operator that goes in and tries to turn that around, brings that occupancy from 40, 50% up to 100 perhaps. That's an opportunistic kind of play. Higher risk, higher reward. We'll talk about it. Quarterly distributions, maybe no distributions if we're talking new development. Equity focus because he wants a $3 million nest egg and he doesn't care about cash flow. Syndications he likes that luxury high-end product in urban areas, Sunbelt regions. You guys get the point. But the thing is, you got to write this stuff down. You got to think it through. I'll give you some resources at the end that'll help you with that. But it starts with your goal. And you know, you're 42% more likely to achieve your goal if you simply write it down. So write down your goals, write them down now, make a note to write them down if you haven't already. Share them with other people too, by the way, that's very effective. So let's dive real quick, a little more into value add, core plus, and core. I know I'm throwing a lot of jargon. If we've got any new people on this call, you're probably thinking, what the hell is this guy talking about? So core, these are just example purposes. This is not, you know, promises, guarantees. This is no deal that we're talking about. I'm just saying, if you invest in a core model, you're going to have lower cash flow because this is the risk spectrum. Just one that was created on, I don't even know where I got this, joefairless.com or something. So you've got, you know, core meaning you're in the core central market. You know, maybe you're in a market that's just done well forever. You're in Chicago, Illinois. You know what I mean? There are a lot of people around. There's a lot of renters. It's a trusted prime location. You're not really experimenting. You're just right there in the heart of it. Maybe it's a nicer, newer, more luxury product. Well, according, you know, to risk, you know, higher risk, higher reward, you might get a little less cash flow off something like that. You know, this is a lot of what institutions are looking for, you know, REITs and mutual funds, pension companies, insurance firms, whatever. And then you move into core plus. So this might be just on the outskirts, you know, of Chicago, for example, in the Illinois example. So you might have a little higher cash flow, might have a little deferred maintenance, maybe just cosmetics, you know, a little paint, little redoing the clubhouse, a little bit in the units, whatever. And so your cash flow bumps up. You have to do some work. So as we talked about before, if you're putting in work, time, and labor, hopefully you're getting a higher ROI. At least I hope you are. And then value add. This is where I play a lot in the space. 8 to 10%. I don't know, man. That's been, you know, kind of what I've averaged myself, just speaking individually since 2015, doing these investments is, you know, somewhere on an annualized scale of 8 to 10. I have properties cash flowing higher. I have some cash flowing a little bit lower because I just got into them and they're a nicer, higher end product. But I'm not even going to get into opportunistic and development. You get the point. Higher risk, higher reward. So think about that for yourself and your goals. Sorry guys, my clicker's going out. But there is no right or wrong. You know, what matters is your risk tolerance, and we're all different. You know, that's the bottom line. So we're wrapping up. Stick with us. We only got a few minutes left here of the presentation. I'm just going to share my 4 steps of how I got. Now, there's so many ways, you guys, that you can build financial independence in this world. That's what I love about living in America. A lot of ways to do it. So I'm not saying this is the right way. I'm not saying this is the best way. I'm not saying this will even work for you. This is what I did. And hopefully it gives you just a thought process that can be useful. All right. So earn as much income as you can using your highest and best earning potential. For me, back in the day, that was an oil industry job, working 100 hours a week, flipping houses and doing vacation rentals on the side. I was hustling, man. I was putting in a lot of hours. And, you know, so yeah, there's some of that. Maybe for you, it's a corporate job, it's side businesses that you could start, whatever it is, right? Earn as much money as you can earn. Don't let off the pedal just yet. And then live on as little of that income as possible for a period of time. Please don't eat burned grilled cheese like I did for years in ramen noodles. It's terrible and it's not sustainable. It's bad for your health. You can eat on the cheap, healthy, by the way, but that's another topic. So, but basically 5-10 years, you know, it takes a little sacrifice, right? Maybe it's not buying the new BMW and Mercedes and all these new luxury things coming out and chasing the shiny object. Maybe it's just sitting back and saying, look, I'm going to focus on the long-term goals. If you guys have ever played around with like a compound interest calculator, you know what I'm talking about, right? It's like you're planting the seeds early, and the earlier you start, the better it gets. And in your later years, it's incredible. So invest the difference between what you're earning and then what you're able to save into real estate. I mean, this is just what I did. I'm not telling anyone that you shouldn't be investing in whatever stocks or Bitcoin or whatever, but I like real estate because it produces cash flow and has equity upside. At least hopefully you're keeping up with inflation through the equity upside if you're not forcing appreciation by making a property better. Last but not least, avoid bad debt. We're talking about credit cards, car loans, personal loans. if you got student loan debt, try to perhaps pay that off. I don't know. Everyone's got a different take on it, but I was fortunate to not take on student loan debt, so that helped a lot. And then, I just didn't get into credit card debt, and I only had one car loan one time, and I paid it off very, very fast. So that can be a huge anchor on what your potential could be. So it's simple, right? But not easy. It's not easy. It's not a get rich quick thing. So, 5, 10, 15 years, be realistic with yourself. The harder you push, the quicker you get there. That's been my experience. So final thoughts. I love this Tony Robbins quote. Most people overestimate what they can accomplish in 1 year, but they underestimate what they can achieve in a decade. Love that so much. Great quote. And a year from now, you'll wish you had started today. I always say that too. So, again, 12 plus years investing in real estate. I couldn't have probably practically started any sooner, but it's better probably now. So is it a good time to get into multifamily? Andy, I was looking at some of the folks you've brought on, and, like Adam Adams, a friend of mine, and I'll defer to those, check those out if you weren't able to attend on YouTube. I'll let other people tell you that stuff. And really what it comes down to is, are you ready? Quick story, side note, 2009, when I bought that townhome I showed you guys, I cannot tell you, 9 out of 10 people I asked, should I get into real estate in 2009? No, you shouldn't. The economy's crap. Do you not know? Houses are just plummeting. They're just going down and down. You're going to lose money. It was right for me to get involved with with single family in 2009 in September. We had not bottomed. We had not rebounded. I took a chance, and there's always risk involved in investing. So you have to decide if it's right for you. I crunched numbers. The ROI made sense. I mentioned I had $640 mortgage payment and $600 coming in passive income. I was living for $40 a month. I thought, hell, even if this house goes down, it's probably not going to go to zero, and I'm able to pay my bills. So it was the right decision for me at the time. So told you I'd do a couple additional resources. Joe Fairless and Theo Hicks wrote the best ever apartment syndication book. What I like about that book is, well, first of all, it's like 400 and some pages. So it's a lot of content, a lot of material. But number two, it covers the active and the passive side of doing syndication. So you can decide for yourself what is the right choice for you. Just because I'm a full-time LP doesn't mean you should be. And a lot of people are a hybrid of the two, believe it or not. GPs are often investing as LPs in other deals, not only their own. Hands-off investor, Brian Burke, CEO of Praxis Capital, another operator out there in the space. Great book for anyone wanting to really, 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 really get analytical and deep dive into being a limited partner in syndication like what I do. 15-minute, one-on-one Q&A call if you guys want it. There's the link. It's ashcroftcapital.com/Travis. You can sign up on my calendar. I make myself available most days per week, most hours, as much as I can. I do these calls, you guys, with no sales pitch, no upsell. There's no strings attached. I talk to 17, 18-year-olds just getting started. I talk to 70 and 80-year-olds just learning what syndication is, accredited investors, non-accredited investors. Reach out if you want to go over kind of, your questions individually. If you don't want to put them right now in the chat or here on this webinar, happy to help. Got a PDF guide. It's called Understanding Real Estate Private Placements. It's all kinds of industry terminology, how to vet a deal, a market, a sponsor. It's only about 20 pages, but man, it's dense. You can download it there. And, I'm not going to bug you if that's all you want. So connect on social media. I'm on LinkedIn, Bigger Pockets, Instagram, Facebook, YouTube. Andy, thanks for the promo there. Actively Passive Show. That's part of Joe Fairless's best ever real estate investing advice podcast. I'm a once per week anymore. I'm really a solo act. I just got a lot I got to vent out. So that's really what I'm up to on that show. But we talk about the FIRE movement, financial independence, retire early. We talk about multifamily. We talk about how to vet all this stuff out. There's so much great content on there. So anyway, that's a long rant, man, but that's all I got. So if we want to open it up to Q&A, that's my presentation. Thanks, Andy. Thanks, everybody.
That was fantastic. Captivating. I was captivated. Thank you so much. What questions do we have for Travis? I know I have a list, but I'm curious about everybody else.
Don't be shy. But
Andy,
like I said,
oh,
sorry, go ahead.
I was going to say, would you prefer we put them in the chat or just shout them out?
Shout them out.
All right. Well, thanks, Travis. That was great. Big fan of your your work. And Andy, this is a great event. I was just going to ask for someone, I'm kind of in your position roughly when you were 18, where I'm building up capital really fast, but I'm not accredited, nowhere close really.
Okay.
And so I'm wondering if there's any careers that you think offer good exposure to syndication, just to kind of get the networking ball rolling. That's mostly my concern at this time while I build up capital on the side.
Sure. Yeah. So when I was crunching numbers in 2015, selling off single family, realizing from cash flow on syndications that I could leave that oil field job, the first thing I did is leave that oil field job. Number two, I went to go work first for like a brokerage firm. So I did the stocks, bonds, mutual funds thing just to learn more about investing and get a more well-rounded perspective. But right after that didn't last very long, by the way, as you probably can imagine. So I went to go work for a startup syndication group. So, perhaps that's something, I think a lot of these newer groups need something, whether it's help with marketing, underwriting, maybe even raising capital. I mean, there's all kinds of things, investor relations, which is what I did, by the way, is investor relations. So that's maybe a foot in the door. The thing I'd tell you about it is don't expect, high salary or anything like that. Maybe you get some kind of, I don't know, profit sharing model or bonuses, or I don't know. But yeah, I would certainly look into that. I think that's, you got to add value to people, and so find a way to do it. Consider that. We can talk offline about, maybe some groups that might need some help. I don't know. Can't guarantee that, but give you a list.
Thank you. I appreciate it.
You bet.
Josh Wine put in the chat, do you think it's better to do multifamily as an individual investor before doing it as a part of a syndication or with partners in general?
That's an excellent question and I'll just give you my perspective coming from an investor relations perspective for years with numerous groups and the brokerage firm and all that. So a lot of people will be LPs before they become GPs for the sense of educating themselves, to your point, right? You're going to get a lot of details, a lot of T12s, a lot of analytics, a lot of monthly updates. You're going to see how they work. You can ask a lot of questions throughout being an LP. So I see a huge benefit versus maybe, hey, I'm going to go pay, $50,000 for this training event or something over here. I think you can get a ton of value just by putting 25, 50K into a syndication. Hopefully you're working with a good group that you can learn from. And yeah, absolutely. But, the answer is that it's different for everybody. So again, I mentioned, why am I not a GP? I like the lifestyle flexibility. My wife and I, we love to travel a lot. We move fairly frequently. And I remember the days of, hey, let's go take a vacation for 2 weeks. No, I got a closing, I got a tenant that's late on rent. No, I got to go do this rehab project. So everything was tying me down to live in the kind of lifestyle that we wanted to have. And so I just made a decision once I found out I could be an LP, that's what I was going to do. So everyone's different. If you feel like that's your skill set, if you feel like you've got connections, you can be competitive in that space, I mean, go for it, I guess. It's a full-time job and it's a lot of responsibility, man. You're taking on millions of dollars from other people. You're a lot of liability, a lot of responsibility. So just be realistic about it. But yeah, if you feel that's a thing for you, sure. Be both.
Right. And honestly, kind of my road is I did the LP first and then I got a picture of exactly what's going on. So I understood, all right, this is how it all rolls up. I can ask questions, I asked tons of questions of my GPs and the sponsors, and just to get an idea of what's going on there. And then you get a feel for like, do I want to deal with that or not? And then after that, you can make your decision. So I think it's valuable to get that LP experience before jumping full force into being a sponsor right off the bat.
Yeah, nothing will make you pay attention more than putting some skin in the game.
Right,
You'll
exactly.
put 50 grand in something, you probably care a little bit. So
right, exactly. Other questions?
Thank you guys for the questions too. Appreciate them.
I'll come up with another one if nobody else has anything.
Go ahead.
This is kind of a quick one, but and I think I know the answer. If you, because I want to start out by house hacking, right? And do that over, a few years to build up some properties. But can you 1031 into a syndication?
Good question. So yes and no. The short answer is yes, but the longer answer is it depends on the group, first of all. So for example, I know like with Ashcroft, the minimum investment's very high. I mean, we're talking about like millions of dollars, for example. So it may not be applicable in your circumstance. Some operators I invest with, they just don't do it. Just the answer is no. In other operators, they do it, and it's a lot lower minimum. So maybe. And so the thing I always say about 1031s is it can be a great lucrative tax strategy, of course, not a tax advisor, but once you jump on that conveyor belt, you better probably stay on it, long term, hopefully, until the day you die. I mean, that's where you're going to get the most benefit out of that strategy. It's much easier in my own experience to do 1031s in single family. And I'll just say doing your individual ownership deals than it is in syndications. Because what if, for example, just something to think about, what if you did a 1031 from a syndication into another syndication with the same group, into another, and now 30 years down the road, they go, hey, we don't have another deal that you can 1031 into, or 1031s get taken away, or who knows what happens politically. Well, you might owe $100,000 in tax that year. Hopefully you got little cash reserves on the side. So I'm not saying people shouldn't do it, but think about that too in terms of that. I think it can be great, but for me being younger, it's not something that I do myself.
Question for you. So you mentioned, there's more and more information, more podcasts, more meetups now than there was, 5-10 years ago. Yeah. Do you think that that's driving the industry to, I'll say, new heights, that, like the value of the properties are going up? Maybe it's more expensive now, but I mean, maybe it's going to be more consistently expensive. And maybe it's particular markets too. I'm just wondering about your thoughts on that, as far as like more people knowing the game and then more people in the game. How is that changing the market?
Yeah, I do think obviously that plays a factor and a role in the big scheme of things. But also what I think is happening from a macro level is we're in such a low interest rate environment that everybody is chasing yield. Institutions, especially with huge big pockets. I mean, you look at was it Blackstone buying up single family homes right now? And I mean, people are making these crazy pivots. And so you're not only competing with other syndicators and other people coming out of these boot camps and training programs and everything else, you're competing against some of these big dogs who, quite frankly, can probably outbid, most people and will do so because they need the property in their portfolio. So think about this. Let's say I'm a hedge fund manager or a mutual fund manager. So if I put in my prospectus to my investors, hey, we're going to allocate 30% of our fund to commercial multifamily real estate. Well, in an environment like today where there's very little supply to be had and things get bought up like that, I have to just buy something, even if that means overbidding for it or whatever. I need to buy it because I'm legally bound to do what I said I would do in terms of that allocation in the fund. So you look at the big environment here and you say, well, as an institution, for example, I could go put money in, the money market's paying 0.1%, the treasuries are paying 1.5%, whatever, I don't even know. And, we could go put it in bonds and get 2%. Or, hey, even if we paid cash for this multifamily asset, cash, no leverage, maybe we clip a 4 or 5% coupon annually. Well, that's not taking on a ton of risk because you're not leveraged. 2, that beats the hell out of those other returns that are your alternatives. So I think that we're going to see more compression. That's just, I don't have a crystal ball, but I think it's very competitive now, and I think it continues to be because everyone just wants to yield, man. Everyone wants passive income. So that's my long and short answer, I guess.
No, that's great insight there for sure. Other questions?
I got another one for you, Travis.
Yeah.
So I was on a similar call yesterday, and there was a lot of talk about kind of how saturated the market is right now because so many people are looking for deals, likely because interest rates are so low and syndication is really popular right now. But with cap rates really low, I mean, do you have any concern that, the saturation is going to become a serious problem in terms of maybe GPs having to force deals through because that's, they're syndicators. And so if the deals aren't working, let's find something. Is there any concern of that? Maybe not tomorrow, but 5 years from now?
Sure. Yeah. So one thing is that we didn't talk about on this presentation is your average hold period and hold time. So a lot of people that are doing value add kind of business models, which I mentioned is primarily what I invest in, usually are underwriting for about 5 years. Hopefully they're being a little conservative in the hopes that they offload the property a little quicker than that. But in general, most deals I've invested in have a 5-year underwriting, but they sell early. So it is important to consider if you're going to go into a deal. Like, for example, I work with one operator. They never project to sell. So I might be in some of those deals for like 20, 30 years. I mean, they literally just don't have an exit that they underwrite for. So if you're concerned about it long term, that may not be an operator, back to knowing your own criteria and risk tolerance, that you would want to partner with, because that is risky. On the flip side, though, maybe they're able to refinance, return capital to investors, and hold the asset long term, and you really don't have any money in the deal. So in that regard, maybe you got a little bit less, risk tolerance. But yes, it's a very saturated market. To your point, I think some operators are doing a deal for the sake of doing a deal. What you want to look for, though, as an LP, which, I mean, seriously, we could talk another 60 minutes about underwriting and red flags and how to vet a deal and blah blah blah. But you want to look for conservative underwriting. For example, are they fixing a long-term interest rate on the deal? And when I say long-term in commercial terms, 5, 7 years, maybe 10 years, that's kind of long-term for a multifamily, keeping in mind your business model is only 5 years, hopefully max. Is it fixed or is it variable? If it's variable, meaning that the Fed tomorrow says, hey, interest rates are 6%, boom. Do they have an interest rate cap? Are they purchasing, which is almost like an insurance policy that, if you locked in at 3 today and I went to 6 tomorrow, the cap would be maybe at 4%. So, you're not going to have the huge debt payment like we saw in 2008, 2009, when, people couldn't refi and they were paying these exorbitant amounts. And then the other thing is, are the loans assumable? If they're going to put a 10-year loan on it, for example, can the next buyer purchase your pre-existing loan? Is it assumable to them at 3% when maybe interest rates are 4 or 5? So there's different things you can look for. Another one is cap rate. So you're buying a property today and it's a 4 cap. Okay. Are they projecting in 5 years that it's still going to be a 4 cap or a 3 cap or a 5 cap? And what I look for, I'm not going to tell you what you should look for. What I look for is a higher cap rate in the future. And what that suggests is I don't want that to actually happen, nor does the general partner. That means a softening of the market. That means that, the higher the cap rate goes up, the lower the purchase price becomes, right? Kind of like with interest rates and single family homes, that kind of stuff. So to be a conservative deal, if we're buying at a 4 cap, I want to see like a 5 cap or something upon exit, maybe even higher. So I'm looking for stuff like that, fully knowing that 3 to 5 years is kind of the game plan here. So it's not a forever thing. So again, we could talk forever about it, but that's a few thoughts.
That's great. I've got another question for you. What's it like working with Joe Fairless?
Joe's a great guy. If you guys don't know Joe, he runs the best ever conferences and the best ever podcasts, and he writes the best ever books and all that. And then he's the GP with Ashcroft Capital. It's great working with Joe. Joe is he's just like one of those rare, amazing human beings that's just truly there for the benefit of other people. And, there's a lot of stories I could share, but it's great working with Joe. The reason that I wanted to come on board with Ashcroft as more of like an active role is, as I mentioned earlier in the beginning, I wanted to get out with wider exposure. I was paying out of pocket myself to go nationwide to real estate conferences. If you guys have been to real estate conferences and you've paid for flights and hotels and then $1,000 or $1,500 to get in and food and the whole deal, it's not cheap. So I thought, hey, here's the deal. Let me, network and present and speak and, help people that way. And then, maybe you guys can get a little bit of my tab. So
Yeah.
kind of a win-win, but, yeah, man, I'm very grateful to work with great people, to work with a great company, and to be an investor with them for many years. So
That's awesome. Great. Any last questions?
Sorry, quick one.
Sure.
Like I said, my flight is about to take off. All right, so I just want to know, because I was talking earlier, like my friend told me about multifamily, and at the same time, I don't really have time to like manage this stuff. Do you like advise I probably just invest with people that are already doing like real estate investment, like just partner with them and just like put that money with them? And on the second part of it is, do you really like advise what kind of certain amount do you advise like one can start with to like put down to invest in all this the gurus?
So basically, you're asking my advice on like what to invest in or how to get started in investing
Yes.
in syndications. Yeah.
Uh-huh.
Well, I can't give advice legally, but what I can say is, just so everybody's aware, is another thing I got all these different PowerPoints and everyone's got different stuff in it. And this is one I created just for this, by the way, but I usually have a slide and we talk about being an accredited investor versus not being an accredited investor, which means that you high net worth, high income, put simply, right? $1 million net worth, excluding your primary residence, or 200,000 a year in income for the last couple of years. If you're married, 300, and stuff like this, right? So the industry of syndications and private placements is kind of divided between deals that are only available to accredited investors and deals that are available to non-accredited investors, where you would be called a sophisticated investor, which means that you have the know-how and the knowledge to understand through your own use or through a financial advisor perhaps, of what you're investing in and what the risks are, and that you've gone over the legal docs, you understand it's illiquid and stuff like that. So the first thing is, understand and decide, are you accredited, are you non-accredited? And then you want to go, again, start with your goal, whether that's a cash flow goal, an equity goal, whatever your goal is. I want to put my kids through college, whatever your goals are. And then go back to kind of that criteria that we talked about and decide, okay, if I have a cash flow goal, I need to be doing cash flow deals, et cetera. Decide, do a little market research, read those books that I recommended, for example, to figure out how you vet out markets and deals and things like that. And so it's kind of a reverse engineer in my mind, right? I start with the end in mind. Here's where I want to be in 5, 10, 15 years, whatever, and my reasons why. And then I'm kind of just backtracking. What's going to get me there? What's the best investment? What if I made, this much cash flow per year? So that's the long answer. The short answer is network. I'm so glad that you're here tonight, and thank you for being here, and do more real estate meetups and read more books and listen to more podcasts and just understand these key fundamentals. Sometimes I make it seem very quick and easy, but the fact is I've been doing this now for 12 years full time, basically. At least the last 6 years have been like hyper full time. But before that, I put a lot of time and energy into it as well. So it takes some time. I'm not saying it'll take you 12 years, maybe you don't read 50 plus books on the topic. Maybe you read 1 or 2. That's more reasonable. But I'm a weirdo like that. So that's what I would do. I would get educated, define your goals, define your criteria, network, meet operators, talk to them, and decide if it's right for you, when it's right for you, and how much you're comfortable putting into a deal. Last thing I'll say is that minimum investments are often over $25,000. That doesn't mean every operator's like that, but most are $50,000, $100,000, $75,000, $25,000. It's going to be somewhere in that spectrum. So just be aware if you're ready to make that kind of commitment, I guess.
Thank you.
Perfect.
You bet.
Okay, one last question for you. So I asked this of all my guests, Travis. How can this multifamily community here help you in your journey?
Good question. I wasn't prepared for that question. You know what, guys, here's the thing. I lived my life at a time where I had no time for others. I had no time to give back. I had no time to do anything, no time for friends, family, or even dating at one point. Now I've freed up a lot of that time because I've invested in this kind of stuff. And so now what I want to do more than ever is just help other people. That's really what my mission is. So how can you help me? Connect. If I can help you, it helps me because that's what my mission is. So reach out and let's connect and have a call. I guess that's the best way.
That's fantastic. Thank you. Well, thank you, Travis. I appreciate you coming on the show tonight and connecting with us, instilling all that great information. As you always do, whether it's through the podcast or other meetups, I appreciate that. Just in closing here, before I close, the next meetup will have Sandhya Seshardi. She is going to speak about her title of the meetup next month is Zero to Your First Million in Multifamily. So, and she's going to talk a little bit about the strategies to use to close your first deal. Again, just a reminder, you'll get a survey from Meetup. Please give your honest feedback. That helps us. Thank you again, Travis. Appreciate you being on the show.
Thanks, Andy. Thanks, everybody. Have a great night. Thanks for making the time.
Everybody, take care.